It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. We've been having a lot of fun in these previous weeks, had some great guests on. It's been a lot of fun going over the Your Personal Bank concept, how it can work. And I guess today what I want to do is really, I've been getting a lot of questions from a lot of people in terms of, how does this work? How would it work for me? So I'm going to address a lot of those things the best I can today. But before I jump into all that, I just want to do a quick review of what Your Personal Bank is, how it works for those of you who don't know, or if you have heard it before, a little quick refresher is not a bad idea. And like I said, if you want to know more information on it, I'm going to really encourage you to go to the moneyradio1510.com, go to the podcast, local shows, Your Personal Bank Show. Check out some of our previous shows where we talked about consumer debt versus strategic debt. We've talked about taxes, taxable, tax-deferred, tax-free, investments, that type of thing. We also talked about compound interest quite extensively on some of the previous shows, plus some great guests, like I said previously. Now, what is Your Personal Bank? Really, what Your Personal Bank is an account that you set up, that you control, you manage. You have access to the funds both for short-term, and you can grow money long-term, compounding on a tax-favored basis. Now, if you're going to understand how to work a personal bank, you've got to understand this other key concept that I've been sharing on some of the previous shows, is how to think like a banker versus an investor. Now, thinking like a banker versus an investor is a difference for most people. I always call it a paradigm shift in thinking about money. Because, see, here's the thing. Most of us are taught to think and operate like investors. And that's been kind of ingrained, if you will, for decades, if not longer, in what Wall Street and various other investment firms and the investor industry is really taught what wants us to do. And the thing is, I'm an entrepreneur. I've shared this also before where, I've owned actually 4 different businesses, starting a 5th one right now. I've started 4 of the 5 myself, and this 5th one's a bank. I'm the chairman of the board of a community bank here in formation. If all goes well, we'll be opening our doors next year, so we're pretty excited. It takes a couple of years to get that off the ground and running. Learning a lot about banking, and this is something I've been sharing with people for quite a few years, but now being the chairman of the board of a bank, a little credibility there, or at least one in the process, so I've learned about it. Here's the thing. How does an investor think? How does an investor operate? Well, in most cases, investors trade hard-earned dollars for assets with the expectation the asset will increase in value. They buy a stock, a bond, a mutual fund, a piece of real estate, a cryptocurrency, whatever it is. It doesn't really matter. And if it goes up in value, of course, they get appreciation and focus on, how many times have you talked to somebody and they're excited about an investment they had? And what's the first thing they always come out and say? I made X amount last year or whatever. In other words, the focus is on the gains. And there's nothing wrong with that, being focused on gains. The problem is most people, most investors I've found in my 22 years experience of being in the financial world and entrepreneurial world, is that most investors think about potential gains almost to the exclusion of anything else or any other parameters. And there's a lot of other things out there that affect an investment, like what's the tax ramifications? What's the risk? What's the potential loss, of course? Things like that. Those are very critical and important factors on any investment. And I find far too often people overly focus on the gains, yet don't focus on the other issues that many times, frankly, are much more important than what the potential gain is. I mean, I think it was Roy Rogers, I believe, who said, I'm more concerned about the return of my money than the return on my money. I think he said it really well. That is a super important key. I mean, you can have a tremendous potential return on an investment, but if there's also a good potential of losing that investment, losing that principal, what's the point? So, other thing is I run into is a lot of investments create little or no cash flow. Now, why is that so important? Well, we need cash flow to live. We need income to live. We have expenses, food, clothing, housing, stuff like that, fun stuff. And the need for income is there throughout our entire lives. That's another mistake I see people often make. They're focusing on, well, I need income in retirement. That's true. We do. But what about the rest of your life? What about when you're first getting started, in your career? What do you need? You need income. What if something breaks? The car breaks down, the roof leaks. Well, you need money. What if you get sick or hurt or can't work? You need income. Or anybody ever have a job loss or a business loss? When you have a steady income that's coming in that's not required for your efforts. Here's the thing I want to understand. If you have to go to work to make the money, then it's not a secure income. It's based on your efforts. That's why residual incomes are so important and so powerful. Even if you're the owner, you take a doctor, a dentist, an attorney, for example, a CPA, any of those professions, and many times, those are folks, if they're single proprietor or even if they work for a company, the reality is their income is reliant on their ability to produce, their activity, their efforts. And I always say, look, if you're a dentist, for example, and you have a dental office and you can't show up, what's your income going to look like with your dental practice over time if you're not there? Well, in most cases, it's just going to go away. So having cash flow or investments that create cash flow is super powerful, and it's a key, okay? And like I said, rarely focus on if things go wrong. So if you buy a stock, a piece of real estate or business, can you tell me what it's going to be worth in a year? And I always like asking that question because people are like, well, not really. You can guesstimate. You can look at charts. You can do all those things. I've done all of those things in my lifetime. You really don't know. You anticipate, but you don't really know. Now, again, this is not from me. This is from a number of different sources. Many books and such talk about this, where they say investing primarily for appreciation is just another form of gambling. They're right. In other words, if basically the only way you can make money is if it goes up in value, and you don't really have a plan for what happens if it goes the other way, how is that any different? Yes, I know you can say strategic look at risk and strategic risk management and things like that. But again, what's your plan B? What happens if things don't go well? So this is the problem that most investors focus on or have is having little or no recourse when things go wrong and having little or no cash flow in most cases. Here's how a banker operates. Here's how a banker thinks. So if you're going to operate a personal bank, you got to think and operate like a banker. Now, something else you need to understand about the banking industry. Again, you like them or hate them. It doesn't really matter here. I think we can agree that banks and bankers are savvy about money. Folks, banks make money, okay? And they understand money. And here's the thing. We can learn from them. You can like something or not, but you can certainly learn from it if it's successful at something. And banking is certainly savvy about money. They're also very savvy about risk management. In fact, the banking industry is more risk adverse and looks at money more different ways than just about any other industry that's out there. I mean, the charts and spreadsheets they produce when we're looking at potential investments and tier one capital for the banks and stuff, when I'm on the bank board, it's mind-boggling almost. I never realized until I got into the banking world that there were so many different ways of looking at risk management for money. And I've been in the financial industry over 22 years prior to that. So gives you an idea. So here's the thing. What's a banker do? Here's how a banker thinks. Have you ever taken out a mortgage or a car loan? Most of us have in our lifetime. Well, when we signed the papers, you knew you were going to have a payment, right? Now, the question is, do you plan to make the payment? Well, of course you did. Otherwise, you wouldn't be signing the papers, right? And the banker knows that also because you went through a whole approval process to get the loan in the first place. And if you're talking about a car loan or a home property loan, for most cases, if you don't make the payments, what happens? They take the asset, right? It's a collateralized loan. Now, the question you need to ask yourself is the banker really risking their money? Because, see, if they're loaning you the money, what are they doing? They're creating an income. Your payments is the income stream, right? And if you don't pay them, guess what happens? They take the asset, sell it to somebody else, create an income stream from them. So I'm going to finish on sharing how your personal bank works, and then we'll get into some questions about who should really look at setting up your personal bank. This is the Your Personal Bank radio show on Money Radio 1510 AM or yourpersonalbank.com.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. We've just been talking about how your personal bank works and also how to think like a banker versus an investor. And really, what's the difference? Investors trade in hard-earned dollars. The asset, to purchase an asset, an expectation the asset will grow in value. And then what do bankers do? Well, they have risk management. Because, see, the investors, in most cases, if the investment goes south, they lose money. They don't really have an option, and many times don't create income or cash flow. So what bankers do? Well, they do the loan. They loan money to create an income, your payments. And if you don't pay them, in most cases, like with cars and home loans, they sell to somebody else and create an income through them. So if you're going to operate a personal bank, you understand how bankers operate and how they think. See, the criteria for a good investment for a banker is this: secure positive cash flow and collateral, or a downside protection. See, you can go to a lender and say, hey, I've got this phenomenal investment, and I can get 20, 30% returns, or whatever the number is you throw out there. If you don't have collateral, some way for them to ensure that they're going to get paid, you won't get the loan. Or if you do, it's like personal lines of credit and things like that, or credit cards and things like that, where you're paying double-digit interest in most cases, much higher interest rates for non-collateralized loans versus collateralized loans. That's the difference. It's about making sure you're going to get your money, and if you don't get paid, you're going to get paid back anyway. That's the key to thinking like a banker versus an investor. Not riding the roller coaster, in other words. Having steady, consistent, ongoing cash flow and income going forward, okay? Now, if you want more information on, how the personal bank works and talking about interest and compound interest, debt, taxes, go to one of the previous shows and on moneyradio1510.com and go to the website and check out our podcast, Your Personal Bank Show, and the local shows, and get more information on that. This is just, I'm trying to go over real quick because I want to cover some of the questions of how this works or who this should work for best. Now, like I said, thinking like a banker versus an investor is key to understanding how to operate a personal bank, because you're going to operate like a bank, your own personal, your business, your individual, whatever it may be. Now, how does a bank operate? Well, when we get a check, what's the first thing we all do with it? We deposit in the bank. What do banks do with our deposits? Well, they loan the money out to earn compound interest, cars, houses, credit cards, things like that. And here's a key thing to understand. What do banks really do? How do they really operate? Well, let's say you opened an account. You walked in a bank and opened an account and gave them some money. Then the next person walks in and says, hey, I want to get a car loan. Does the banker give the cash you just gave them to the car loan person? And most of the time when I ask that question, the answer, people think, well, I guess so, yeah. And the answer is no, they do not. What they do is they take your cash you gave them to open your account and they stick it in the safe. Now, is cash an asset? Of course it is. Can you borrow against an asset? Well, of course you can. We do it all the time with houses, cars, and 401ks and et cetera. Well, you can borrow against cash too, okay? See, here's the thing. Banks don't invest in the stock market. And when I say that, a lot of people are a little bit surprised, because when you walk into a bank and you got too much money in your account, what do they tell you to do? Well, you should meet with our specialists here and look into investing in things. And why are they doing that? Well, I can tell you as a chairman of the board of a bank, why would a bank encourage you to take excess funds that are in their accounts to invest in investment products? So the bank can generate fees, okay? Just another source of revenue for the bank. There's nothing wrong with it. Just understand that's how it operates, okay? But the banks themselves, what do they invest in primarily? Not in the stock market. What they do is they earn compound interest on our deposits. That's their main focus. and they borrow against the cash they hold to earn more interest, and so can you. In other words, the more and more cash you have available, the more you can access and use it for various purposes. And by the way, that brings me up to the second big key financial concept, wealth key, if you will. The first one was think like a banker versus an investor. Protect the downside, have collateral, and create cash flow with your investments, because we need money to live, right? At all stages of our life, not just in retirement, but in all stages of our life. The second big wealth key concept I've been sharing is access to capital is key for financial success. Why? Well, for two main reasons. The first, opportunities. Have you ever run across an opportunity where you thought, you know what, I can make some money with that. If I put some money towards this investment or whatever it is, I feel strongly that I can make some money from it. I've run into those things, and as entrepreneurs, we do that all the time. In fact, we do that with our businesses on a regular basis. But when you don't have access to capital, or if the capital is tied up due to penalties or tax reasons or various other things, it can eliminate that opportunity because the cost of getting the money is just it's too much. And it's frustrating. There's almost nothing more frustrating than seeing an opportunity that you know in your gut it's going to work out, but you can't do anything about it because you either don't have the capital to apply towards that opportunity, or the capital you have has restrictions, taxes, penalties, various whatever, or at the very least, loss of potential growth. You can't access it. See, what Your Personal Bank does is it allows you short-term access to monies at a very low cost to take advantage of those. In other words, if you had an investment, let's say it was going to average 7% return in your investment account, and you see this opportunity and you think it'll make you 10, well, your net, if you take it out of the 7% investment and you do make the 10, you increased your return by 3%. But you got to be pretty darn sure it's going to do the 10. Otherwise, why bother with the 7? You see what I'm saying? Losing the 7. A personal bank allows you to access those funds, at least for the short term, year or less, and get the 10. You'll put the money back in and still pick up what you were going to earn in the personal bank and not lose that compound interest in your account. It's phenomenal. And if you want more information on it, contact us at yourpersonalbank.com or toll free 866-515-6280. I'd be happy to share with you and look at your situation. This isn't for everyone, okay? But what I will say is, if you have not looked at this, do yourself the favor and do so. It can change your financial future for you, your business, and your family. This can be a generational shift of monies. This is how the wealthy operate, by the way, in many cases, passing on funds tax favored to the next generation, for example. You can build that kind of wealth and have short-term access for your short-term needs for opportunities. What's the other reason why access to cash, capital, is so important for financial success? One is opportunities, taking advantage of those. What's the other one? The other one is needs, emergencies. Folks, stuff happens. That's life. The reality is, things happen in our lives that cause us to have emergencies, that cause us to have needs for monies that are totally and completely unexpected at times. We don't know what's around the corner. We don't know what the future holds. We have to be prepared for that so that when that emergency or that need occurs, or that economic dive or the job loss or the disability or the business loss, whatever happens. And, many times a lot of these things are completely out of our control. We don't predict them. We don't know they're going to happen. It's right around the corner. We don't even see it. Life is like driving at night, and you have the headlights on, and you're going down a curvy road, and there's a curve ahead. You don't see it yet. But other times, if you're driving down the road you've never been down before, because that's what life is like, curves occur that we don't see, and we don't even know they're coming. And if we're going too fast or not paying attention, we may see it too late, and then we get hit, okay? you have to be prepared for those unexpected emergencies. You have to have access to cash for those unexpected emergencies, or otherwise it can be devastating. What do I mean by that? If there's tax consequences, penalties, tax penalties, various other limitations to access to the funds, or again, selling a stock at the wrong time, for example, can be devastating. And unfortunately, we can't predict when those emergencies happen. So having that access to cash and knowing it's there when you need it is key to financial success. Next segment, we're going to go into looking at who should look at a personal bank. And contact us for more information at yourpersonalbank.com or toll free 866-515-6280.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Hey, welcome back. We've been talking about a lot of great stuff today in terms of, what is Your Personal Bank and how to think like a banker versus an investor, which is one key, wealth key. Another wealth key we've been sharing, of course, is access to capital. It's key to future financial success. If you missed the previous segments, go to moneyradio1510.com, listen to the podcast, go to local shows, Your Personal Bank Show. Check it out. And any of the previous shows, you'll get more information on. We talked about debt, taxes, compound interest, any of those kinds of things. You're going to find some very interesting information. And like I said, I'm coming at this not just as a financial background, but an entrepreneurial background. I've owned 4 companies, starting a 5th. I've started 4 of the 5 companies that retail business. I'm the chairman of the board of a bank we're in the process of forming right now. I've owned a service company, and of course I own a financial agency, insurance agency. So it's been quite a ride, a lot of fun, learned a lot of things, and working with clients for the last 22 plus years. And you start to learn some things about what works and what doesn't. And like I said, thinking like a banker is key. Protecting the downside, creating cash flow, because that's the things we need throughout our lifetime. We get into financial problems when we lack cash flow or lack income that we need to pay for the basic needs of life. That's when financial stress occurs. And we need access to capital without a lot of restrictions and penalties and taxes throughout our life for those opportunities and those emergencies, okay? And so we need to protect the downside, stop riding the roller coaster, as I call it so much. Protect some of those downsides like bankers do and create that cash flow. Now, what is a personal bank? Well, we create an account that's an asset that's guaranteed and insured. The principal is guaranteed. You have access to capital day one. You can earn interest on the asset and the borrowed funds, and you can create tax-favored growth and withdrawals. Now, you have to structure it right. Again, this isn't for everyone, but you have to make sure you structure this correctly to make it work for you. Now, you'll actually, if you set this up correctly, you'll have somewhere between 2 to 16 times more total dollars to spend in your lifetime doing this versus not. Sometimes people look at me funny when I say that, but it's true when we run the numbers. Now, of course, the difference is how much more you're going to have. Part of it is how it's structured. Part of it's how much you fund it and how you do it. And part of it is a factor of how long you're going to live. Compound interest works the longer you have time to work it. So for somebody younger, they're going to have a higher multiple, if you will, because of compound interest. But it still works if you're older, okay? Now, the tool we use an insurance tool, something that, a lot of people are surprised by. We could use any financial tool. Let's face it. It's not that we use that one in particular for any reason other than a process of elimination. Why do we use this tool and a very specific type? Well, we want compound interest. We want increasing cash flow every year. Okay, so an investment that doesn't increase every year is off the table. We don't want any risk of loss. We don't want to borrow against an asset like I talked about earlier. Bankers borrow against cash to create interest, create more income. You can do the same, but you don't want to borrow against an asset that can lose value. That's a recipe for disaster. So obviously anything market related or can vary in value up or down is now off the table. We want liquidity. We want access to 50 to 80% of our money day one. Okay? And I'm pretty excited. We've got some tax-favored options today that we can use where we can have access to anywhere around 75, 80% of the monies and still have it access it income tax-free. I can share with how that is done, We have to set it up specifically, but it's pretty exciting for the right person in the right situation, okay? We want access to funds, no penalties, age, or other restrictions, all right? So, we don't want to have access. And what I mean by that, to define that a little further is, we don't want to put it into an account where you have tax penalties or account penalties or things like that to access the funds, or you have to be a certain age to access the monies, those kinds of things. We want to eliminate that as much as possible, okay? Having access to your money to use it properly so you can eliminate all those penalties or tax ramifications, okay? And we want to set it up correctly so that we can have income tax-free growth, income tax access, and pass on to the heirs income tax-free, okay? Up to certain limits. Currently, but the bottom line is it's pretty exciting when you think about what you can do. And all these tools, of all the financial tools that exist out there, there's really only one that encompasses all of these characteristics: the compound interest, eliminating the loss, having access liquidity to your funds, and having tax-favored growth and access. There's one. It's your personal bank and the insurance tool that we use to support that. So here's the thing. What type do we use? Well, it's a high cash value type product. And I'm going to tell you real quick, without getting into a lot of detail about it, because there's a lot of different ones out there. If you look at an illustration, there's a lot of products out there that are sold by advisors and such as a high cash value investment tool or life insurance product or whatever, growing cash. And we run into this all the time. Here's a simple way, one simple little thing that in about 5 seconds, you can figure out exactly whether the tool you're looking at, is really maximizing cash or not. It's quite simple. Look at the first year cash value line. On the illustration, you have to get an illustration to set one of these up. So at some point or another, you have to look at and sign for one. So you might as well ask for it and look at it. If the amount of cash available to you is less than 50% of what you contribute that first year, that tool is not structured correctly. It is not designed to maximize cash growth for you, the client. Now, there's many reasons behind that. It might be the wrong tool, the wrong product, or not structured correctly. But I just want you to understand that is a very simple thing to determine and look at, 50% or more. Now, many cases, and most of the cases we work with, we're closer to 80%. Again, it depends on how it's structured. 60 to 80% is the normal range based on age and health and other factors that we run into. But at least 50 you want to be looking at as a good rule of thumb or better. And if you want more information on that, contact us at yourpersonalbank.com or toll-free 866-515-6280. If you have an illustration, email it to us or send it to us. We'll do a head-to-head apples-to-apples comparison, and we'll show you 99% of the time, based on our experience the last number of years, we can show you how to generate and have more cash first year and every year, which is the key. Okay? You want more cash. Because how do you structure these things? It's really quite simple. If you think of a teeter-totter, if you visualize that just for a sec, most insurance contracts, and this is the problem I run into, if people have a negative response or stop listening, it's because they think of insurance as a liability or an expense, not an asset. They think of the car and the home and all those other things. The last thing I need is another bill. How much am I going to put into this? They're missing the whole point. We're talking about building an asset, growing cash. We're not talking about a bill or an expense. Now, do you need those things? Sure. Should you have homeowners insurance and auto insurance and life insurance to protect you in case something happens? Of course you should. I have death benefit protection needs like many of us do. I have a family, own a business, various needs of protecting in case, as the primary breadwinner, something happens. Many families have that need, and you should take care of that need. That's an expense. That's a death benefit protection tool. That is not a cash growth tool. And most policies, even ones that have some cash or a little bit of cash, are really heavily weighted towards the death benefit protection because their purpose, irregardless of what the agent may or may not say, if the numbers tell the story, the purpose is really about death benefit protection primarily. first and foremost, not growing cash. So if you think of a teeter-totter, as I was stating earlier, most contracts are structured with little or no cash, maximizing death benefit. Term, for example, has no cash. It's a death benefit protection tool, strictly. Okay? What we do is you flip the teeter-totter the other way. We maximize the cash and minimize the death benefit. That's the goal, because we want to maximize the amount of cash grown. Now, there's 3 different options available in terms of maximizing cash. There's a fixed, indexed, and leveraged options. So in other words, for that person who's looking for a steady, consistent, regular type of return, fixed is for them. Somebody wants to be more market-related, indexed, typically S&P 500. And then the leveraged option is where you bring in a partner with a lender, and they bring money in, and you're combining the efforts and the contributions to maximize the amount of cash later. The leverage option is pretty cool if you qualify for it and you're comfortable with that. I'm going to go into these 3 options further and, again, answer a few questions in the next segment. If you want more information, contact us at yourpersonalbank.com or toll free 866-515-6280.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're rounding third for the last segment. We've covered a lot of great stuff. We've talked about debt, taxes, compound interest. We talked about how your personal bank works, and we talked about the tool, the very specific high cash value the high cash value tool that we use, insurance tool. And I'll tell you what, it's a very specific type, structured a very specific way to maximize cash growth, not to maximize death benefit, like most insurance contracts are. How do you know? I gave the secret in the last segment. Well, guess what? I'm going to tell you the secret again if you missed it. Here's the secret to know whether your tool is maximizing cash or not. You want to know what it is? Look at the first year cash value. On an illustration, if 50% or more is not available first year of what you contribute, it's not designed to maximize cash. It's just that simple. It's not structured correctly. You either have the wrong product, the wrong tool, or it was structured incorrectly. By the way, in most of our scenarios, cases we deal with clients, this is based on the last 7 years' experience, we're able to get most people around 75-80% access to cash first year. Day one, in fact. Again, every situation is different. Doesn't work for everybody, but I'm just telling you, in most cases, that's been our experience. Okay? Now, again, it's not all about access to cash short term, because you want to grow money long term, tax favored. That's the long term goal, and we're accomplishing that. But it's nice to know that you have access to cash if you need it, which is one of the key success principles in terms of being successful financially: access to capital. Now, like I started to mention in the last segment, there's 3 different primary options you can go with. You have a fixed option for consistent returns, guaranteed type returns where you can grow money every year for those that want that stability, that consistency of growth on their money. There's been a lot of talk recently, and I don't like to, use dates and stuff here a lot of times because, gosh, I've been doing this over 22 years, and I've seen 3 market cycles, economic cycles. And there's a lot of talk recently, a lot of risks about trade wars with China and stuff like that, and a lot of concerns. You go back and it was, the dot-com run-up, and then there was the mortgage crisis. I mean, the thing is, cycles happen. Don't be surprised by them. That's part of life. That's part of the financial world. I always say, and you know what? Most people, what I find they do is they ride the cycles up and down like a roller coaster. Most people get a little frustrated when the roller coaster's gone the wrong way and get really excited when it's going up, but they don't know how to get off the ride. They don't realize that there's another option because, we're told, hang in there, we're investing for the long term and all those things, which is true. I'm not going to argue that point. But emotionally, a lot of people struggle riding the roller coaster, and it's just frustrating. And good example, annuities, fixed and index annuities have been denigrated and challenged and attacked by many people for decades. I started selling fixed index annuities over 20 years ago when they were barely known. And you know what I found, and what's turned out to be true is there's just an awful lot of people out there that once they're presented with an opportunity to get off the roller coaster, they take it. They understand the wisdom of putting their money in an account that's going to grow, but won't go down at least in bad years, and will go up in good years. So they don't have to ride the down. And now there's, every year it seems like more and more monies. It's in billion plus now year of new business going into annuities in the United States. Why? Despite all the denigration and all the attacks, people understand protecting the downside makes sense. Well, with a fixed, consistent return on a personal bank, you're accomplishing that. What's the negative in annuities? What gets attacked all the time? It's real obvious. There's penalties involved, early withdrawal penalties. Most annuities have 10% free withdrawals after the first year, so you have access to 10% of your money each year. Now, that may or may not work for you. If it doesn't, if you want to have potential access to more than that, look at a personal bank, because you can get similar returns, oftentimes better, with much more access to funds if you do need them, which is nice. There's the index options. It's typically based on S&P 500. Principal's guaranteed, so you don't have any downside market risk. So in the good market years, you can see double-digit returns. In the bad years, you don't lose. That's a nice combination, okay? So you can see some real potential growth there, if you will, without the downside risk. And then, like I mentioned earlier, there's a leveraged option where you can get a partner with a lender that'll contribute along with you, and what that accomplishes is by two of you contributing more money, two parties, there's a whole lot more cash involved down the road in most cases for that person. This is the tool. The leveraged option is what's used many times in executive benefit plans because they're tax favored and there's a lot more money. If you can qualify for one of those, it's real interesting to look at. Okay, so those are kind of the options. Now, what do people do? Some questions. Well, the bottom line is this. What I define as what's called a passive investor versus an active investor. See, most people are actually passive investors. What they do is they contribute money, which earns over time. They can get, with a personal bank, they can get consistent growth, either based on the fixed option or indexing. There's no downside market risk in either option. They have access to funds if they need them. There's a long-term care benefit built in and no extra cost, which is really awesome because that can be very expensive. There's a death benefit protection for heirs if something happens prematurely. And you're building tax-favored income for retirement. Those are all good things. It accomplishes what most people want to accomplish with their investment money. The thing is, if you're a passive investor, if you're investing monies somewhere, consider this as an option. One of the main advantages you would gain from this option versus most others is you would gain downside market protection versus most investments out there, and access to the funds if you need them for an emergency or see an opportunity. See, most guaranteed options, I'm thinking things like CDs and certain annuities and things like that, have significant limitations, serious limitations to accessing the money without penalties, especially in the early years. Here you don't. You can have access to the majority of your funds right away if you do need them at a very low cost. So it's nice to know you have the access. Most passive investors are not looking for the access. They just like to know that it's there in case an emergency comes up. Because this is rainy day money. This is retirement money. This is down the road money. This is college funding or whatever. Or they're building something as a cash reserve for their business or whatever. It's long-term rainy day money. But it's nice to know you have access if you need it to a majority of the funds. You don't get that with the safety with most investments. So there's a couple of major benefits and the long-term care and death benefits that are there that you just don't get with other options. So it's worth looking at. Again, not for everyone, but certainly worth looking at. The active investors. Those are my entrepreneurial folks. And who are those? Well, gosh, if you get a 1099 or you own an entity, an LLC, a corp, or any of those kinds of things, the IRS considers you an entrepreneur, basically. So if you fit into those categories, those kinds of people tend to transact business and have more needs for access to capital for opportunities to expand their business than others do. And guess what? Your personal bank is a perfect credit facility tool for that type of person. So the active investor does everything the same thing as the passive investor. They contribute funds, it earns over time, they can get consistent growth either on the fixed or index side. They eliminate the downside market risk. They get a long-term care benefit at no additional cost, death benefit protection, build tax-favored income for retirement. But here's the difference. They have access to funds for opportunities because to an entrepreneur, that is key, that's vital, and that's super important. So for the last thought on that, I get a lot of business owners, entrepreneurs and stuff. They look at putting in monies into IRAs and SEP IRAs and 401ks and things like that. Well, if you're the business owner, if you're the entrepreneur, there's no match. There's no company matching the funds. You don't get that advantage. So it's your money that you earned, your business earned. And yes, you get some tax deferral today, but you don't really have, depending on your age, you don't really have access to those funds. Certainly not to 59.5 without some tax penalties. So having access to capital for that entrepreneur is key. It's important. It's worth looking at. For more information, contact us at yourpersonalbank.com or toll-free 866-515-6280. And if you want information on any of these things we talked about previously and more in depth, go to moneyradio1510.com. Go to the podcast, look up the local shows, Your Personal Bank Show, and check out on some of the subjects we've discussed and some of the guests we've had visit us. Come check us out and listen every Tuesday at noon on Money Radio, 1510 a.m.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.